Because the world will be radically different in 5 years. And it's going to go year by year, become radically different. Next elections, the debt situation, all of these things are going to change.
Many viewers have been concerned about the impending crisis and how to deal with it. So let's see what Ray Dalio, the founder of the world's largest hedge fund Bridgewater Associates, one of the most important voices in global financial markets, and the Steve Jobs of investing, has to say. Ray Dalio is closely watching the fiscal situation and believes the US is going to have a debt crisis that will affect every major and every common man like you. How fast it transpires is going to be a function of that supply-demand issue. The country's debt has been under scrutiny after political brinkmanship around the debt limit earlier this year, which brought the US close to a default. In August, rating agency Fitch downgraded US credit rating by a notch from the top tier, citing fiscal breakdown over the next 3 years and repeated down the wire debt ceiling negotiations. A looming government shutdown could elevate the country's pain. Dalio talked not only about investing in a tough market and the difficult times ahead for the global economy, but also about how to survive in such times. According to him, we have to look at 2 factors. The normal economic factors, particular the enormous creation of debt, then the monetization of that, which means the central bank printing money and buying the debt. But at the same time, we are going through 2 other factors that are disruptive and connected. One is a great internal conflict due to large wealth gaps, which we can see in elections all around and particularly in the way the United States is fragmenting. They are not just money issues, but ballot politics, and secondly, we have internationally a great power conflict. Because the US is no longer the sole dominant power, we have a massive rivalry between China and the United States. And that is having economically disruptive effects, for example, how it makes supply chains more difficult, and that adds to inflation. It's the interaction of these things that is creating a much bigger problem. So, if short rates indeed approach 5.5 to 6%, is that baked into stock prices already, and has the market factored it in fully? No, it's not priced in, because what's priced in rather is that there will be a sharp fall in inflation rates. There will be a fall in inflation rates as some of the exogenous factors like the oil price won't stay up where it is, so that'll bring inflation down some. But that brings it down from a very high level of 8% to something lower than that, and not sustaining. Pessimists are warning of a 1970s-like situation where inflation surprises us and lingers on at a very high level for many years. And not surprisingly, those risks are very high. We are at a paradigm shift. We know that we are going to spend a lot more money than we are taking in. In the US, we will have a budget deficit in the vicinity of 5% of GDP, and there are so many demands on money. Now the dilemma for any investor is how do you preserve, or at least conserve, your wealth at a time like this. Dalio is famous for maintaining that cash is trash for most of his investing career, but recently that changed. He said that interest rates have now risen to a level where it's not as trashy. When we had 0 interest rates almost, of course, cash was terrible. But now he said he would call it neutral, no longer trashy. It is harmful to other asset prices, though, and what you're going to see is a classic sequence of events where the interest rate rises high enough that it is good for the creditor, but bad for the economy. And when economic conditions again become a bigger worry than inflation, you will see central banks come in and print more money. So it's very important for investors over the long term to not hold debt instruments. Over the short term, fixed income is neutral to slightly attractive, but in the long run, look at your returns relative to inflation, because too many people look at just the level of returns, and they don't pay enough attention to inflation. Secondly, stay away from debt assets and debt-denominated assets. Lastly, have a well-diversified portfolio, because diversification reduces risk without reducing expected returns, if you do it well. Try to not be too tactical and realize that the markets are a zero-sum game. And to compete in the markets is more difficult because many more people are trying to do it and take money away from others. Touching upon the third point about the changing political power axis, because that's important. We've lived 75 years without any major war globally. So is it about to change? For this, Dalio said that he's a student of cycles and their mechanical cause, effect, and linkages. And if we take the financial issues and the measures, size of the wealth gap, size of political gaps, amount of populism, external factors, the conflicts between countries, and the military buildup, they are all at the highest levels since the tumultuous 1930 to 45 period. And that is a period we are in again. What we're seeing are no longer minor country confrontations like the United States against Afghanistan or Iraq. It is now Russia and China. So, there are 5 kinds of wars. There is a trade war, a technology war, a geopolitical influence war, a capital and economic war, a military war, and the US is already in the first 4 of those. Even if we never participated in a major military war, we still have damage happening. Globalization is declining because of fears of those looming wars. There is the desire for self-sufficiency. It used to be that the world would come closer to producing items wherever it was most efficient, but that is now changing. Now, it is wherever it is most secure. We have to assess investment destinations keeping this in mind because neutrality is important. The 3 things that you should look at according to Ray Dalio while assessing countries is first the financials. First, do they earn better than they are spending financially? Or do they have a good balance sheet and good income statement? Second, do people within the country operate in a balanced way? Healthy competition, but not destructive political, dysfunctional behavior? Third, are they at risk of an international war, or are they more neutral and staying out of the international war? If they tick these 3 boxes, you should favor those countries. Dalio says both the economic and political cycle are going to get worse in the US and elsewhere. We're going to have more internal conflict, more economic problems like stagflation, and that'll take us into the 2024 election. Similar patterns are visible around the world. So as we go into the 2024 period, you're going to encounter more of those problems. So, if there is to pick a time that he thinks will be particularly challenging, it'll have to be in the vicinity of 2024 to 25 perhaps. The main thing is that the US doesn't get into an all-out war, because if this just becomes an evolutionary struggle, we'll get through this. Even in depressions, most people remain employed, and even in wars, most people don't get killed. It takes a while, but you can get through it. What do you think? How are you going to implement Dalio's advice? Let me know in the comments. As always, make sure to like the video and subscribe to my channel so you can be financially free. Until next time,